Welcome back to another Market Insight Call where we sift through the noise, get to the signal, give you actionable advice. Joined as always by Aaron Tuttle. Anything you want to cover this week?
Why don't we cover all the headlines that are happening?
Okay. All right, we have an outline. We'll go through it, and it is going to start with the war plan. Should you, how would you, and should you allocate differently during wartime versus peace? And part of that is going to be part of a strategic asset allocation, one that's more long-term, versus tactical, responding to the headlines. Should you do a tactical asset allocation? We'll move on to hub accounts. I know that's your favorite topic.
It is my favorite topic.
Talking about our cash, fully funded. A lot's changed. We'll review inflation. Got a new inflation report too, and interest rate forecast. And of course, we will close with investing through war. It's going to take time. We're not here to try to predict headlines. That's the wrong game. We want to make sure we're setting up portfolios for the long term because it's inevitable that we will be investing through periods of war. And eventually it will be similar to what I have written here with Russia-Ukraine, which was all the headlines for a really long time, and we haven't talked about it for 12 months.
We actually were talking about how we got censored before. They wouldn't allow it because there were so many headlines on YouTube. So
we had a great video with Jeremy Schwartz from Wisdom Tree that YouTube took down because we were talking about the topic. And
absolutely.
Eventually the market will recover from those news. It may take time. It may take more time than Russia-Ukraine, depending where this escalation goes. But the plan is to make sure we're creating portfolios for the long term. Let's take a look at what the market has done over the last 6 months. So the blue line is the trend. It's the 50-day moving average, straight up through those periods. The red line below the market, 200-day moving average, both still in strong uptrends. Mm-hmm. Last week, we did have a break in the 50-day, which is not a good sign. You don't want to see a break in the 50-day. Like we say with technicals, they matter to the market when there's not news. You're going to trade on technicals when you have nothing else to really trade on. We had geopolitical headlines. We fell straight through the 50-day moving average. It did not act as support. The other thing I wanted to point out was the bottom right is the relative strength, just short-term trading oscillator. When it gets down to 30, it's generally historically a good buying opportunity. You can actually see the far left side where it did bounce off 30 and was a good buying opportunity. Haven't gotten there yet. Right? We haven't been putting in cash for clients that do have really long time horizons sitting with some cash. We have not looked to buy yet because we still have some rough headlines ahead of us.
Right, so if we were just looking at technicals, we would say, well, we may not have put the bottom in yet. It's not a time to be aggressive on your allocation.
Yes, and when we look actually to the last few days, I know it seems rough that the market has been moving downward, but what I see is actually a market that really wants to rally and wants to move past it. And I did want to spend a couple minutes talking about what we saw there. So I boxed off on the right the S&P 500 the last 3 trading days. So starting on 4/12 on Friday, we have a classic, which reminded me a lot of trading during COVID, which is you have some headline coming up. This was Iran wants to retaliate. Don't know what it's going to be. Market does not, short-term investors do not want to hold stocks into the weekend. They don't want to take on that risk. They're selling. We had a down 1.5% day on Friday. Of course, we have the headlines on Saturday. We know what happened. We move into Sunday where the news was actually, Israel says, we don't need a response, we're okay. That actually had a strong recovery. Almost got back a lot of those losses. The futures market Sunday night surprisingly opened up, 50, 60 basis points, traded up an entire 1% the next morning before they changed their narrative to imminent response coming. And really the market's been sitting on this imminent response from Israel for 20 to 36 hours now at the point, and really trading headline to headline. But we did see yesterday on Tuesday kind of an indecision day, not a whole lot changing on that candle on 4/16, and some strong rallies actually throughout the day, trying to rally, trying to move past this. But there is a lid on the market. I think it's rational. I think it makes a lot of sense that the market should not rally until we can get past these headlines.
Yeah, at some point either you're going to run out of people that want to enter the market and see this as a buying opportunity, and then you'll start to move downward, or we're going to get past this and the market's going to rally. It's one of those two components if we just sit here and stay and kind of grind through that process.
So if we were to look at a tactical asset allocation, what would make sense? What would perform the best during a period of war? I'd say gold performs historically very well. Mm-hmm. So does oil, right? You get the extra demand from war and supply shocks as well. So then energy producers do well. Of course, defense contractors, the defense stocks do well. And then the treasury bonds, that's an interesting one. The flight to safety, where it might do well. We talked about the war is very inflationary. So inflation is not good for bonds. So it doesn't necessarily have to do well. It might be more of a hedge compared to corporate bonds, where treasury bonds will outperform. And of course, there are other hedges like cash or defensive stocks, which you'd expect to still go down with the market, but maybe not as much. Healthcare, utility, and staples. The problem we'll see with tactical asset allocations is they really are negatively correlated, a lot of these, meaning when peace breaks out, there's some premium that's built into these that's going to go down. Right? They're going to hedge your position, but in the long term, there's a potential for them to go down as well.
And one of the things that's interesting, since we do pay a lot of attention to technicals, is they were starting to push us in these positions before these headlines were here. So there's actually a couple of trades that look like were geniuses. We weren't. It was just the technicals were putting us there, and it happened that we took positions as those headlines were coming the next day.
And our strategic asset allocation, where we think the business cycle's going over the next several years, is based on inflation. Yeah. I know you'll talk a lot more about that when we have our inflation chart that we will close with, but that's going to push us towards things like gold and strategies that have a mandate that can hold gold, and energy producers too.
And that's probably a good segue to talking about on the recent portfolio changes. But I did want to remind anyone, especially if you're not a client, if you ever want to review the way your portfolio is set up versus how we would do that, we can actually provide that. Just reach out to us and we can do an analysis to say this is how you're positioned, this is how we would have been positioned, so it's our actual strategies, and you can compare your portfolio to what it would have been historically. Obviously, we always have the disclaimer, past performance is not indicative of future performance.
Perfect. Let's go look at some of those changes we've made over the last month or so, and some actually last week. And we can start with our signal strategy. It's a very tactical strategy. It's the only strategy that I'd say so far has had a tactical asset allocation tilt because of this. When we looked at positioning last week, the way we measure relative strength, commodities were considered negative to us. We weren't able to add to them because of our rules in the portfolio. So we weren't able to add commodities until this week. Of course, commodities, about 50% of the basket, can be oil, energy, and precious metals. So like we talked about, those do well in periods like this. We're able to add to that in signal as a tactical change. But over the last month, we added to energy producers through an international growth, to international value change. So just looking at how the portfolio is set up in signal, so far, it doesn't look like we need to make any other changes.
It was an interesting thing I saw. It was the 10 most, the GDP, the states that have done the best on GDP, the 10 top states, almost all of them is because of oil. The only one that stood out that wasn't oil was Florida, and it was more retail. So we can see this as actually having an impact in the underlying economies of those states, being that their GDP was higher than the national average.
Yep. A similar trade that we made in our ETF strategy, where the strategy's mandate does not allow us to hold gold or precious metals directly, but we can hold the producers. So we bought a producers fund, global commodity producers fund, that's going to get us exposure to energy, precious metals producers, a little bit of staples, because you have some of the ag side that gets categorized as a staple, and other commodities producers. So we do have that position in ETF, and MOAT's probably the biggest one. Over the last 18 months, it's our best performing strategy. It's outperformed the S&P 500, and part of that is we had a little higher volatility than the index. And up until about a month ago, we wanted to start reducing that. We had a couple positions like NVIDIA and Costco that just rallied too hard for us. We wanted to reduce some of our exposure, and we did that. We added to gold. We added to some treasuries from that Costco position that gave us 3 years of expected returns in just a handful of months. And we do have a defense stock in the position too. And our beta is tracking under 1, which when we look at it over the last 18 months, we had a strong upside capture. And lately with this volatility, we've been capturing less of the downside, which is a very attractive measure that we've seen in MOAT.
Right, and so we're not trying to time the market by any means. We're just trying to adjust the risk factor for where we are in the market. When we're looking at it, it does seem to be a little extended. It's a little overvalued. So going away from being more aggressive to slightly under the S&P 500 makes a lot of sense to us, and these trades have done that. and they've done it well. The upside capture is great, and the downside capture, hopefully we don't see it, but should do well for this position.
Then the final trade that happened a month ago, when you talked a lot about it when we looked at fixed income, the risk, the premium you're getting for taking additional risk on BBB exposure, which is bonds at the lowest level of investment grade, was at historic lows. And we saw that. We had strong appreciation in our corporate bonds. We wanted to make a change. So we did make a tactical change at the time from corporate bonds to a strategy that is no longer only focused on corporate bonds, but can also add treasuries. And of course, I wanted to close with the history, a chart from war versus the full history of investing. And this is from a blog from the CFA. And what we see, I've drawn green boxes around what I wanted to show, which is the full history of their sample from 26 to 2013. They show 10% return on large cap stocks. The way they drew all war periods, it actually showed that war was good for stocks. I don't agree with that. I wanted to put this here to show just how you can make the data fit your narrative, and also when you have to decide what data do you include. Well, they didn't include anything after 2001. That would actually probably bias your sample up. They didn't include World War I, which after there was some market closure for a few months, and then market rallied pretty strong. So it's difficult to decide in your sample, what do we include if we want to see history of how you've performed. But the way they did it and the way they drew up their periods, they showed it was better. But we can look at a different example from, we already talked about Jeremy Schwartz and Jeremy Siegel, and their book Stocks for the Long Run. They said that the period of war and peacetime is actually the exact same nominal returns. The real returns, however, during war are lower because inflation's higher during war. And that's really what you'd expect.
Right. Whenever you're in that position, governments are going to be accommodative. They're going to have a larger impact on the economy. You would see inflation. I also agree with you that I don't think building things to just blow them up are necessarily good for the long-term economy. But what this tells us is don't go to cash. Right? Just stay invested, because at the end of the day, you're going to get a better return for your portfolio over the long term.
When you're looking at data that can be changed so much by changing your start dates for your work, your start date at the beginning or the end date, and your sample changes by that much, we look at it and say, it's just like trading. You have to get those small periods right, or it's going to make a large change. So our conclusion, no matter who you look at through these data providers, is stay invested, hedge a little bit. We have small hedges that are already in place. Don't think we need to add to them at this time.
Right, and the thing that I've learned over time is you're never going to open up the Wall Street Journal and say, hey, everything's great, you should invest. It's always going to be a headline of what to be concerned about. War is just another headline to be concerned, but you invest anyways. That's actually what gives you good returns long term, is that uncertainty, because there's always some issue to be bearish about in the economy.
Anything else you want to close out before moving away from headlines?
No.
Let's move to seasonality, something we talk about every time this time of the year in April, because the headline will actually be sell in May and go away. And for good reason. There are a lot of academic papers that have shown it works as a strategy. You remove your allocation in May. Some people buy back in September, some wait till November, depends on the author of the rotation strategy. But a lot of them show they work. So that can become a self-fulfilling prophecy. What we're showing on the chart here is monthly returns on average. You can see May, June, August are weak months, not negative. September is on average a very negative month. So this can give some volatility to the market. It's not a strategy we're going to be acting on, because there are several periods that it still is a poor predictor. But it works well in a academic journal where it doesn't matter about those years where you miss out.
Right, they're just looking at average, and you only get the return for that year, not the average return.
Right. And on top of this, we do have a couple, as always, the months are difficult, but in a presidential election year, with the sitting president, the sitting administration, wants to do everything they can to get elected. And there are great data showing that third quarter, as they're preparing for the election, is actually really strong returns in the market. Right. So we do have that seasonality later in the year that should help us as well.
There's always a bear and there's always a bull case, no matter what the price is. And you can make the bear case, and we're positioned for that. We have full cash hubs. We talked about the lower beta. We've talked about the defensive positions. So we're positioned for the anticipated volatility. We expect some turbulence here in the market, but we also know that it's better just to wade through those and deal with that on a risk basis versus trying to time it, because the market seeks to punish as many people as possible. If everyone acts on this, it's going to be the wrong decision.
Right. We had an inflation report come out in the last several days. Anything you want to go through with it?
I think we're going to continue to see persistent inflation. I don't think we're going to see things like we did coming out of COVID, 8-9%. I think 4 to 5 is certainly likely. 3 to 4 is probably most likely. And a lot of things have turned. Where we saw 2%, where the geopolitics of the last couple of decades were globalization. You had the third world and second world, those labor forces really coming on to the market and the demographics being in favor of reducing inflation as labor costs came down. You had the fracking revolution. There was a lot of things that were helping keep inflation down relative to the amount of monetary stimulus that was being created during that time. Those trends are unwinding. Now, once again, not saying 8 or 9%, but I think the Federal Reserve will be surprised on how persistent inflation is there. They are above where inflation is coming at right now, so for their standpoint, they don't need to raise rates, and they do have some room to cut, but I think they're going to see somewhere between 3 or 4%, and I think that's actually good long term, because it's forcing people to actually look at how are they making investment decisions and not just getting exposure to some market factor. It's how do we create value? How do we reduce our consumption because of these factors? So I think in the long term, that's good. But I don't think the Fed is raising rates, and I don't think they're going to aggressively cut them. But they could if we were all of a sudden to see that labor market. So I think we're in a pretty good position. It's just going to feel like a grind as we go through this.
Mm-hmm. That's a great summary, right? Because Powell gave a speech earlier in the week where that's what he said. Because the market, you're going to get, during these headlines, you're going to get people that do doomsday headlines that come on TV and say the Fed needs to raise rates. And like you said, he just said, we don't. If inflation's trending at what you just said at 4%, and they're at 5.5% on their rates, they still would consider that restrictive. But they don't need to cut rates at that point. And the market's starting to understand that the expectations of rates going from 2 to 3 cuts this year to 1, 2, and eventually if the market's doing well, labor market's doing well too, and they don't have to cut rates, I think the market's starting to understand that that's a possibility now. And that wouldn't necessarily be bad for the market if they don't have to cut rates.
I think the C-suite, which is going to have a lot of options, can't count on the Fed being aggressive on their cutting for their stock price. So they're going to look at their P&L and figure out how can they add value that way. So I actually think this shapes out as a much better economy, a much healthier economy than just looking for the Fed to be accommodative to make the market go up.
The other big thing we got going on right now is earnings season really kicks off now. Last week we had the financials reporting. Not enough companies to really want to say beat rates. They look like they're coming in at the average beat rates we've seen, maybe a little above average, but most of the index is going to be reporting their earnings in the next 2 to 3 weeks. So we'll have something to talk about next month related to corporate earnings, but at least now, just wanted to throw this in here and show that the forward 12-month expectations for earnings is higher. It's coming in, as we've talked about, that we no longer have these soft quarters where we can easily hide behind and say, well, business, we don't need to grow earnings too much. We're getting to the point where earnings growth is going to matter. We don't see any reason why that the growth is not going to be there, but it is just going to be difficult reporting and getting your stock to perform while reporting in line or trying to keep your expectations for guidance going up.
Yeah, I think it's the low bars of earnings are over, right? Yep. So it'll be an interesting market going forward, and it's going to be great to see that data come in.
Thank you for joining Market Insight. Go ahead and hit that share button, share it with someone that you think would find it useful, and we'll see you next month.